Welcome to London Property News Bulletin. Every week, we break down the key headlines and the wider news that could influence the market, keeping you informed and confident in your decisions. Here is what you need to know this week.
Speculation over how Andy Burnham will reshape property taxation is already doing the damage the reforms themselves have not. With a proportional property tax and a land value tax both mooted, buyers and sellers are hesitating rather than committing, and prime London, where transactions are already thin, feels it first. Burnham has ruled out scrapping stamp duty in his October budget, but agents warn that rumour alone is enough to freeze a market. Clarity, not consultation, is what the capital now needs. Burnham has backed the fairest share model, a 0.48% proportional property tax with annual revaluations, which would turn house price growth into a recurring liability and, critics argue, penalise the very build-to-rent investors the capital relies on for new rental supply. Knight Frank's Tom Bill warns that targeting developers, landlords and overseas buyers tends to reduce stock and push rents higher. For prime London's rental pipeline, policy signalling has become a genuine risk. The nationality of Britain's landlords is shifting. Hampton's data shows Indian nationals formed the most new buy-to-let companies in the first half of 2025, followed by Nigerian, Polish and Irish investors. The EU share of foreign-owned BTL firms has fallen from 65% in 2016 to 49%. 1 in 5 new BTL companies now has at least one non-UK shareholder, and London holds the highest concentration. Nationality is not residence, but the capital's rental ownership is quietly internationalising. Nearly 1 in 10 UK property purchases now draws on funds held overseas, according to Third Fort's analysis of more than 1 million source of funds checks. India is the most common origin, followed by the US, Hong Kong, Italy and China, with China displacing France in the top 5. The figure is not a count of foreign investors. A UK resident may simply hold wealth abroad, but for prime London, it confirms how globally sourced the capital's buying power remains. The government consultation now underway could reset what leaseholders pay for decades. Running to 39 technical questions, it sets the valuation rates for the new standard valuation method under the Leasehold and Freehold Reform Act 2024, governing lease extensions, freehold purchases and ground rent buyouts. Small movements in those rates shift thousands of pounds between leaseholder and freeholder, with much of prime central London held on leasehold and pension funds, holding an estimated £15 billion in ground rents. The stakes are considerable. Institutional money is still moving on London rental stock. 3 bidders are competing for the roughly £350 million Fizzy Living portfolio, close to 1,000 build-to-rent homes across Greater London, being sold by Greystar and Adia, who acquired the platform for around £400 million in 2021. The pricing tells its own story about where BTR values have settled. That serious capital still competes for the asset class is a quiet vote of confidence in London's rental fundamentals.
That wraps this week's London Property News Bulletin. Thank you for listening. If something caught your attention or you need support navigating the impact of the news, then please reach out to us. We're here to guide you. If this was useful, do pass it on to someone who also follows the market, and don't forget to subscribe to stay one step ahead